Special funds in Kenya have been gaining a lot of attention recently, and for good reason. Some are offering returns of around 20% in shillings and about 12% in dollar-based funds. But here's the real question. If you had the same amount of money, would you be better off investing in shillings or dollars? Let's take a real example. We're comparing 650,000 Kenya shillings invested at 20% per year and $5,000 invested at 12% per year, both compounded monthly over 1 year. And importantly, that 650,000 Kenya shillings comes from converting $5,000 at an exchange rate of 130 shillings to the dollar. So, we're comparing the same starting value. Let's go deeper. Now, this might seem like a simple comparison, but this is actually the kind of decision a lot of people are making right now. Should you invest locally and aim for higher returns, or move into dollar-based assets for stability? Because the truth is, the difference between these two decisions is not just percentage, it's how your money behaves over time. At first glance, the answer seems obvious. 20% is higher than 12%. So naturally, most people assume the shilling investment wins. But that's only looking at one part of the picture. Because once you include currency, compounding, and actual ending value, the answer becomes more interesting. Let's get into the numbers. First, the shilling investment. 650,000 Kenya shillings at 20% annually, compounded monthly, grows to approximately 793,943 Kenya shillings. That's a profit of about 143,943 Kenya shillings. Now the dollar investment. $5,000 at 12% annually, compounded monthly, grows to approximately $5,636. That's a profit of about $636. Now we convert that back to shillings using 130 Kenya shillings per dollar. This gives us 732,680 Kenya shillings. That gives us a profit of 82,680 Kenya shillings. So if we compare them side by side, shilling investment 793,943, dollar investment 732,680. The difference 1,263 Kenya shillings. So purely on this one-year calculation, the shilling investment clearly wins. But this is where most people stop thinking, and that's where mistakes happen. Assumptions. First, the exchange rate. We assumed 130 Kenya shillings per dollar. But if the shilling weakens, that dollar value increases. Second, the returns. We assumed 20% for the Kenyan shilling, or 12% for USD. This is based on current estimates, but in reality, these are just estimates. Returns can vary. Third, risk. Higher return often comes with higher uncertainty or less stability. So this is not just a math question. It's a decision about return, risk, and currency exposure. So how should you actually think about this? Here's a simple way to look at it. If your goal is maximizing short-term returns, then higher yield local investments can make sense. If your goal is preserving value over time, then dollar exposure becomes more important. If your goal is balanced growth, then you probably shouldn't choose one. You should combine both. This is how more experienced investors think. So, what's the final answer? In this specific example, the 650,000 Kenya shillings investment wins on pure return, but that does not automatically make it the better decision. Because the better decision depends on your goal, your risk tolerance, and your time horizon. Good money decisions are not just about chasing the highest percentage. They're about understanding what the numbers actually mean and what they don't tell you. And if you want to understand what you should actually look for when choosing between different funds, watch this next video, because that's where most people get it wrong.